Go live. What I was going to say, Farhan, is I like going to Europe in November and December, specifically because it's cold and it's the Christmas season, and Europe does the holidays quite well. And I was curious if Estonia buys into the Christmas markets and all of
Yeah,
this.
there's a very beautiful Christmas market in Tallinn, and I was there. Yeah, I was there 2 weeks before this one. It wasn't snowing, but it was cold. It was windy, and I've been here for almost 3 years now. So last time for last 2 years when I was visiting Christmas market, it was snow both of time. So it was different because there wasn't any snow, but it was windy. I've heard a lot of good things about a Christmas market in Austria.
Hmm.
Um, I'm not sure if you have been there.
I've been, I have. Vienna's actually one of my favorite cities in the world. If what you're looking for is kind of like golden age European like grandeur, just like giant buildings, pretty lights, good food, cozy, all of that sort of thing. Vienna is one of my favorites. London was good. I was just in London over Thanksgiving, and it was very Christmassy. They do a good job. It's not kind of the German, kind of cozy Christmas markets, but it's bright lights and giant Christmas trees and very English. We'll kill another minute or so, letting people trickle in, but we're expecting a big turnout today, and so as usual, as you all come in, don't hesitate to drop a line in the chat, letting us know who you are, where you're from. We always see some familiar names, and it's fun to see those, and also some new names and faces. So let us know who's here. We'll give it another, I don't know, what time is it? Give it another 30 seconds, and then we'll kick off. Only got Nupur is here from Austin, Texas. Great. We've Chaitan from Chandler, Shosh in Davenport, Iowa. That's Davenport, Iowa. I'm not sure why I have an association over there. It does look like the names are maybe getting mixed up a little bit here. The StreamYard doesn't like to make this easy. Someone from Raleigh. All right, well, it's 202, 203. We can kick it off. See the numbers ticking up. We'll get it rolling, and people can trickle in. Welcome everyone back to another weekly Valur webinar. This is Farhan, is this our last one of the year? Or we're done after today?
On the ordinary income side of things, probably yes.
Yes.
Maybe
It's the 18th. Next week is Christmas. I don't think we're doing one on the 25th. So this is the last one for now, at least. We're going to be talking about ordinary income. I know a lot of you all will recognize us and recognize the thing here, but you've got me and Farhan. I'm Jeff. I'm part of Valur's founding team. I run product development. I'm also a lawyer by training, and talk a lot about this stuff. And I've spoken to many of you. I see a bunch of names that I recognize in the chat. And I've got Farhan with me. Farhan's a senior account executive and is the one that many of you will have already talked to or will talk to about ordinary income planning for this year and beyond. Speaking of which, that's what we're here to talk about. And actually, Ash asked a very basic question that's really important. And so to frame this, what are we talking about here? Is ordinary income the same as W-2? And I also want to talk about timing. Ordinary income and W-2 are similar. W-2 is one type of ordinary income. What we're going to be talking about today is tax planning for income that is taxed on the ordinary income schedule. That's the tax brackets that you will know just from kind of being in the world. The top federal ordinary income bracket is 37%. If you live in California or New York or New Jersey, you're paying very high state tax as well on your ordinary income. So we're talking about W-2. We're talking about 1099 income. We're talking about income that you earn from running your own business. Essentially anything that you receive in return for doing something, for doing work. That's what we mean by ordinary income. It's worth noting that many of these strategies do apply actually just as well to other kinds of income, like capital gains. Not all of them do. Some of them do. But because the capital gains tax rate is lower than the rate on ordinary income, we're focusing today, and many of our clients are focusing at this time of year, on ordinary income planning. Speaking of which, I mentioned timing. We're talking today about strategies for 2024 and beyond. It's December 18th. And so one major question here is going to be, is there still time to do something here? And the answer is going to be yes, in some cases. Not all of the strategies that we're going to be talking about today are still available this year, but many of them are, and we'll be very clear as we go through about which strategies fall into which of those categories. And so we'll talk about some basic principles, and then we'll hit on 3 categories of strategies here, going from what I think of as simplest to most complex, starting with tax-deferred accounts, which are your IRA, your 401k, your basic tax planning. We'll just hit on those very briefly. Charitable strategies, some of which are simple and you know about, some of which are a little more complex. And then the real stuff, real estate, oil and gas, and solar, which are probably the highest return, but also require the most kind of legwork and elbow grease. So getting right into it here, before we get to the strategies, we wanted to take a moment to make sure we're all on the same page as to the basic principles that we're talking through here. So starting from what I think of as kind of the top of the funnel, or the first step in this process, what are we doing here? What's the goal? And the answer is, of course, we're trying to reduce your taxes, but we want to be precise about hey, Sandeep, I just saw you chime in. Welcome. We want to be talking, we're talking about 2 distinct concepts here. Of course, we're trying to reduce the taxes that you're going to pay. But in many of these cases and these strategies, what we're going to be talking about specifically is reducing your taxable income. And that move, reducing the income that you're taxed on, will then have the effect of reducing your taxes. That's a distinction that's going to matter when we're talking, for example, about deductions and credits, which I'll get to in a second. But I just want to be clear that those are 2 different things: reducing your taxable income and reducing your taxes. I'll actually talk about deductions and credits next because it's natural. There are 2 types of tax benefits that we're going to talk about a lot today, and in general that we talk a lot about, and those are tax deductions and tax credits. A tax deduction, you're all familiar with. It's usually the kind of thing that we're talking about, that you're talking about when you're talking about personal income tax planning. If you give to charity, you get to take a deduction off of your income. If you have a mortgage, your interest on that mortgage is tax deductible. And what that means is that you're taking that amount and you're reducing the income on which you're paying tax. Now that's different from credits. Tax credits, like, for example, the credit for buying an electric vehicle or the child care credit. These are tax benefits where we're not reducing your taxable income, we're actually reducing the taxes that you're paying. It's a subtle distinction, but an important one. So if you make $100,000 and you owe $50,000 of tax, a deduction of $50,000 is going to reduce your income from $100,000 to $50,000, which is going to reduce your tax bill probably about half, maybe to $25,000, maybe a little bit less. A tax credit, by contrast, of $50,000 isn't going to affect your taxable income of $100,000, but it's going to go straight to the bottom line and reduce your tax bill. So if you have a $50,000 tax bill and then you get a $50,000 credit, well, now your tax bill is $0. And so again, that's an important distinction. And the strategies that we're talking about today, some of them yield credits, some of them yield deductions, and some of them yield both. And so we want to make sure that you all understand that distinction. Taking one step back to understanding marginal tax rates, this is another basic concept that most of you will have under your belts. But just to be very clear, the US at the federal and almost every state level has a progressive tax system, meaning that the percentage of tax that you'll pay on every dollar of income goes up the more you make. So at the federal level, if you make $10 of income, you're not going to pay any tax on it. If you make $12,000 of income, you're going to pay 10% on the dollars over some threshold. I don't have the brackets memorized. If you make over $1 million, you're going to pay 37% on your marginal dollars, but you're still only going to pay 10% on that first, whatever it is, 48,000 or so. And that's the progressive marginal tax system. And why that matters is when we're talking about tax deductions, we're deducting off of the top line, off of the top of your income. And if you make $1 million, every dollar of deduction is going to be worth a lot because you're paying a very high marginal tax rate. And so taking $1 off your income is probably going to save you 37% at the federal level and potentially as much as 13 or 14 at the state level if you live in one of those high tax cities and states. Whereas if you only make $50,000 a year, a $1 deduction is probably only going to save you like 10%. It's not quite as valuable. So because of the marginal tax system and the progressive tax system, the more money you make, the more valuable these strategies are. So there's just a couple of basic principles. Farhan, you want to talk about active and passive and depreciation?
Yeah. So thank you, Jeff, for laying the land here. In terms of active and passive income, the distinction here is very important. And the reason we'll come back, that's very important. So the active income here is the income where you spend certain amount of hours and IRS considered active. So suppose you're working for a company, you're a tech employee, you're working there. So the W-2 income that you're going to earn will be considered active. If you buy a rental property today and you're not spending any time to maintain it, nothing, you just bought it, it's generating a rental income, that is considered passive. The distinction, it's not about the amount, the marginal tax rate you're going to get taxed on. So it's not that if you're buying the rental property and since it's passive, you're going to get taxed on only 20% of it or only 30% of it. It's still an ordinary income. And if you are an active W-2 employee, it's the same tax rate. The distinction comes into the place when you are writing it off. How much losses, whether it's active or passive, we'll come to that. And now taking it as, another step, we're coming towards depreciation. Now, depreciation is actual losses that you take when you buy something. So suppose if you buy a rental property, if it's worth $1 million, you get to take $1 million worth of depreciation. Suppose, the life is 10 years, you get to take it over the course of 10 years. This is a depreciation that's coming from an asset that you bought. Now, the distinction linking it back to active versus passive is that you can take those losses if you have, suppose if your income is $100,000 and you have a $20,000 worth of depreciation, you can take those losses to write off your income. But the distinction here is that you need to be active. You need to have active losses to write off active income, which means that if you buy a rental property today and you are passive in that, whatever depreciation is coming from that rental property cannot be used against your W-2. You have to be active in the real estate space, which IRS has a very clear requirement of 750 hours and some other underlying requirements as well. But to make this clear here, you have to be active in another space to take losses, to take that depreciation and to reduce your taxable income where you are active, like your W-2 income most of the time. Jeff, if I missed something here.
No. You've hit it and more, Farhan. I want to kind of get into the strategies because this all is going to become especially important when we're talking about things like solar and oil and gas. And I think we can be very concrete when we get there, but very helpful overview. We're about to turn to the individual strategies. And I just want to kind of set the stage here as to how we're going to approach this. We're going to be working from what I think of as the simplest, but also lowest value, low-hanging fruit, and also the things that you don't really need Valur for. You can do on your own. Working up toward the more valuable, but also more effort-intensive things, and also the things that we can definitely help with, as you all know, just to kind of put in a little plug and make sure we're all on the same page. Valur's business, the point of all of this is to help you find strategies that are going to be positive ROI for you, and then to help you implement them. And so we'll kind of highlight where Valur actually can help and where you might think about getting in touch versus where these are things that you can do on your own. So starting with tax deferred accounts, we're going to be, I think, pretty quick on this slide. These are going to be things that most of you are very familiar with. And also that don't require a ton of nuance. we're talking first about tax-deferred accounts. And the idea here is that you can take some of your income and put it into a special account, whether it's an IRA, a 401k, or even a cash balance plan, which I'll talk about, and deduct that amount from your income. There's nothing magical here. You all are aware of IRAs and 401ks. Essentially, whether it's through your employer or not, if you take some income and put it into a 401k, you're reducing your taxable income and therefore saving taxes on that amount. And it's also going into this account that then is tax deferred, which means you're not paying taxes on the gains while they're happening or while you're selling inside of the account. You're only paying taxes way down the road when you withdraw. One of the reasons that we don't focus too much on these strategies is just that they're simple, that you all are very aware of them, and also that the limits are relatively low. The maximum you can put into an IRA this year is $7,000. I think it's $8,000 if you're over a certain age, 50 or 55. With a 401k, the maximum you can personally put in is $23,000, plus a $7,500 catch up if you're over 50. So the most you can do here is like $30,000 in a regular 401k. That's great. And if you're in a high tax state, doing that could save you $15,000 in taxes. You should absolutely do that. But there are bigger ticket items here. There are ways to save much, much more than that. So we're not going to talk much about this. And again, you can do this on your own as long as your employer offers it. Number 2 on this list, solo 401ks, very similar, but applies only to those who own their own business, whether it's a small pass-through LLC, if you're doing some work on the side, or whether it's a more complex or more serious small business. If you are on your own, or you and your spouse, you can do a solo 401k, which offers higher contribution limits. You can do the $23,000 as an individual. You can also, as an employer, give up to a percentage of your profits from the business, maxing out at $69,000. A few key ideas to look into here. Again, just speed running through these particular strategies. When you have a solo 401k or a 401k with a company that allows it, it's worth exploring backdoor and mega backdoor Roth contributions. This is not the focus today, and so I'm not going to spend too much time on it, but that is one very popular way and a way, kind of a method that's having a moment kind of on social media and in the industry, a way to get money into a tax advantaged account in kind of creative ways. And then the last on this list, cash balance plans, just a supercharged 401k type strategy. If you're a small business owner, that's something you can implement and pursue. It's really only a fit if your business is making good money, good steady money, let's say $300,000 or more, and if you have very few employees. But if that applies to you and you're relatively successful but small, you can definitely pursue that. Again, not something Valur helps with, although we do have partners who do. So if you need a referral, definitely don't hesitate to get in touch. Mike asks a relevant question, which is, and Mike, it's good to see you again. I feel like we see you every week. Is there a solo 401k as a Roth? And the answer is yes. You have to set it up, and there is still time this year. If you're running a small business or a solo business, you can set up a solo 401k that's either traditional or Roth or both. When I was a lawyer, there was a time when I was running my own practice on my own, and I had both a solo, a regular, and a Roth solo 401k. So yes, that is definitely possible. That was very quick, but again, not the focus today. We really want to make sure that there's time for the heavy hitters here. And so we're going to turn to charitable strategies. As many of you know, this is very relevant to Valur's business. We do a lot of this work. And so we want to talk about a couple of principles and then highlight a few specific strategies that you could consider pursuing before the end of the year, or of course in the future. The first concept here, and the reason that charitable giving is often very popular, I guess the big picture is, well, when you give $1 to charity, you get to deduct that dollar from your income. And that will reduce your taxes. That's why people give to charity, or that's one reason that people give to charity. They're also, of course, doing good. The way to optimize this in general, in addition to pursuing the strategies that we'll talk about, is to bunch donations. This is a very common strategy for those who are charitably inclined or who are looking to offset significant income. And the idea here is that you are taking all of the money that you're going to be giving to charity over the next few years, and you give it all in 1 year. And by doing that and taking a larger deduction in 1 year, you're able to push your income down significantly in 1 year, if you're in the higher tax brackets, that's really valuable. It can also sometimes have the effect of knocking you down into a lower tax bracket, which can be a powerful tool. So if you're considering giving, significantly and steadily over the next few years, bunching those donations into 1 year can make sense. Now we're going to talk in a second about one specific trust-based strategy that allows you to do that in a really effective way. But Farhan, do you want to talk about the kind of limitations here?
Yeah. So as Jeff mentioned about the deduction that's coming from charitable sources, the one thing to call out here is the limitations of how much income you can reduce in a single calendar year, because it's very important. If you're making it $1 million and you think you can give $700,000 to charity and reduce your AGI by $700,000, government doesn't let you do that. There is a certain amount of limitation here to make sure that you pay a certain amount of taxes. You are not reducing it to zero, and that comes into play depending on what you're contributing. So the major distinction is whether it's you contributing illiquid stock, you have highly appreciated stock that you want to give it to a charity or a charitable organization. Then there is a different limit, and that limit is 30% of your AGI write-off, which means if you're contributing, if you have $1 million, 30% of your AGI is $300,000. That means whatever amount of deduction you are getting from that source, if it's $500,000, you can only get to deduct your income by $300,000. That's it. You have to carry forward the rest of the $200,000 to future years. You cannot make your income zero, so you don't owe anything in taxes. And that's what we wanted to call that out. And if you're contributing cash, then the limitation is 50%, so you can write off 50% of your AGI. So the distinction here depends in terms of what you're contributing, and then it's 30% or 50% of your AGI. You cannot go all the way and can make your taxable income zero.
That's right. By the way, someone asked, I don't know if it was Noah Beecher or somebody else, something weird's happening with the names in the chat. Yeah, that's definitely true. So we're gonna, I guess, keep calling you out. If those names are wrong, we apologize, but we'll answer the questions in any case, and we'll look into that after the fact. What's going on with the platform? So moving on then to the types of charitable strategies that we want to talk about. You can see along the bottom here that we're going to be explaining these along the axis of purely altruistic to purely self-interested. Now, we're talking about this in a tax seminar, and Noah says it's a feature, not a bug. That's funny. So none of this is purely altruistic. Just to be very candid, you're here to talk about how to reduce your taxes. If you're giving money to a donor-advised fund or a foundation, it's not purely altruistic. You get a deduction, and we'll talk about that. But those are definitely on the more altruistic side of things for reasons that I'll explain, whereas charitable trusts are more on the self-interested side of things. So starting on the left, donor-advised funds and foundations. The idea here is very straightforward. You can get $1 of deduction for every dollar that you put into a charity. You can give to a nonprofit. You can give to a donor-advised fund. You can give it to a private foundation that you've set up and run. In all cases, you can get an immediate 100% tax deduction, subject, of course, to those limits that Farhan talked about as to how much of your adjusted gross income you can write off. The value of doing this via a donor-advised fund or a foundation, as opposed to giving straight to charity, is that you can give this year, potentially bunching those donations and increasing your deduction, and you can spread out the donations. So if you put $100,000 into a donor-advised fund or a foundation this year, you get a $100,000 deduction, but the money stays in that account, and you can invest it, you can grow it, and you can give it out to charity over time. And that can be valuable if you want that big deduction this year, but you're not ready to commit the money to a particular charity, or certainly all of the money right up front. Now, the downside of this approach, and the reason that it sits on the altruistic side of things, is that you're giving the money away. People talk all the time about donor-advised funds and foundations and charitable giving as a tax strategy. And our view is that, sure, it is. You're getting a deduction, but it's really only for folks who are charitably inclined anyway, because you're not seeing that money again. You're giving the money away, and you're taking a deduction, and it's going to charity eventually. Now, with a foundation, you can pay yourself or pay your family members to run it. With a donor-advised fund, there are certain ways to get some of the money back. But for the most part, it's staying in there. And that's why we view these as mostly charitable strategies, whereas the next two are much more on the self-interested side of things, because in both of the next cases, CLAT and CRUT, you get to keep a substantial amount of the funds that are going into the trust while also getting charitable benefits.
I also would love to connect DAFs to our next slide on the oil and gas, and making a comparison, because I've gotten this question, and I think it's a good thing that you called out that you lost that dollar on the day. I mean, if you're doing it for philosophical reasons, that all makes sense. But if you're thinking it's a tax mitigation play, then there may be better things out there with the same risk profile they can execute on. But we can talk about this in terms of charitable lead annuity trust. This is before we go into how that is and how that works on a higher level. Charitable lead annuity trust is a tool that is you can set up to avoid, to reduce your taxes on ordinary income. The distinction here is very important, because we charitable remainder trust is our top product that I could say at this point of time in the year. And we've been saying the charitable remainder trust only solves for capital gains; it doesn't solve for ordinary income. So the distinction here is charitable lead annuity trust that you're looking at solves for ordinary income, and charitable remainder unit trust solves particularly for unrealized capital gains. So we just want to make sure we call that out. In terms of charitable lead annuity trust, if you give $1, if you put $1 into a charitable lead annuity trust in a CLAT, like donor advised fund, you get $1 worth of deduction. Same limitation of AGI applies, 30%, 50% of your AGI. But if you put $1 in, you get to take $1 worth of deduction in year one. Simple as that. The upside here is compared to DAF is that you get to grow the money inside the trust. There is a certain amount that goes to charity every year over the length of the trust. But whatever is left at the end of it, the remainder in the trust, you get to keep it tax-free. So if you set up a trust, if you put $1 million inside a CLAT and you set it up for 20 years, the money is going to grow. A certain amount is going to go to charity every year. And at the end of, and I'm just using a high level math, so don't count me on the numbers. If there is $100, $200, $500,000 left at the end of the trust after 20 years, you get to keep it tax-free. And that's where the value proposition lies. Now, I'm not sure, we have to cover another slide in terms of time, so I'm just going to quickly go through charitable remainder trust. And
Farhan, I agree we should speed, but let me just do 30 seconds on the mechanism of a CLAT, because this is something that actually is quite powerful. I want to say a CLAT, we've of course run the numbers. We do a lot of our work quantitatively, as you all know. CLATs are going to be a good fit. Certainly, they're going to be better than a donor advised fund because you get to keep some of the money. And in addition, they're going to be an especially valuable tool if you're planning to give money to charity anyway. Someone, whether it was Ash or otherwise, asked if they can get a recording, and the answer is yes. If you're here and registered, you're going to get a recording afterwards, so don't worry about that. The way a CLAT works is that let's say you put $100,000 into the CLAT, you get the deduction today as though you had donated that money to charity, but you don't have to give it to charity right away. Instead, you get to invest that $100,000, have it grow over time, and give the money to charity over time, so that by the end of the term, you've given the $100,000 plus interest to charity. But in the meantime, if the money's growing and invested and it beats the interest rate, let's say the interest rate is 4% and it's growing, $100,000, 4% a year, you're going to end up having to donate probably about $200,000 over 20 years. If your investments return 10% and as a result are worth $400,000 at the end of 20 years, you've given 200 to charity, but you get to keep 200. And in that way, very obviously, if your goal is tax planning as opposed to charitable giving, you're doing way better with a CLAT than you would be if you just do a donor advised fund or foundation. So that's a very important distinction, and why we always say, if you're looking at a DAF, you should absolutely be considering a CLAT. So Farhan, do you want to just very quick touch on CRUTs?
Yeah, I'll quickly go over it. So charitable remainder trust quickly specifically solves for unrealized gains, and it's best suited to sell if you have a highly appreciated asset. And a highly appreciated asset can be a rental property that has appreciated a lot in the value. It can be crypto, which is getting up. It can be a public company stock that you own, that you bought. It can be a business that you're selling, and we have seen that a lot as well. So it can be anything that is highly appreciated, doesn't have a debt on it. That's very important because a trust cannot own something that has a debt on it. In real estate, particularly, some properties have mortgage on it, so I want to make sure that's cleared. But that's a constraint here. So you put an asset inside the trust, you get a charitable tax deductions. If you put $1 million in, you get 10% in tax deduction. You get to sell the asset inside the trust tax-free, no taxes because trust is tax exempt. Then you get to reinvest that money as well inside the trust. You can do almost anything. There are few constraints, but almost anything. You can invest in stocks, bonds, ETFs, private investment, bunch of stuff. And then you get to take money out of it every year, that you pay taxes on. So the value proposition lies in, and it's a slightly complex product, and we'll be happy to get on a call with you to explain this. But the higher level value prop is that if you put $1 million in, and if you live in California, you're going to pay around $650,000 just in long term. You're going to pay $350,000 in long term capital gains, and you'll be left with 650 to do whatever you want to do with it. In a trust, in a charitable remainder trust, if you put that inside the trust, you get $100,000 worth of deduction in year one. You get to reinvest the full $1 million, so you have a $350,000 worth of a head start. And that's why the money grows faster inside the trust. And suppose if you're getting, I don't know, $50,000 and 55% in distribution percentage, or even 10%, $100,000 in distribution, you're paying taxes on that $100,000. You're not gonna have the same marginal tax rate as you would have been selling in $1 million. That's tax law harvesting. And looking at these numbers and everything, you can get a 3 to 4x return. There are some variables here, and we have a calculator where you could play around with the numbers to see the ROI in your situation. But the important piece here is that we have seen people getting 3-4x return, in comparison to if they would have just sold the taxes and paid the taxes on that and invested the money. And one thing I know, Jeff, you're gonna add something just to clarify, everyone.
Yeah.
Charitable lead annuity trust is something that you can execute within the time that you have left. Charitable remainder trust is also something that you can execute with the time that you have left with the Valur. Specifically, I want to say, don't want to oversell this, but that's where the Valur comes in. That's where the tech comes in, and that's why we have been able to execute these things in a very efficient manner, rather than you going to an attorney. He's asking for 2 months from now what's going to happen and everything. So if you are thinking you have a highly appreciated asset, you want to take the deduction, there's still time to do this. But
That's
Jeff, I'll let you.
And just to that point, very excitingly, right now we're getting you your trust within 24 hours. Within the next couple of weeks, we're going to be moving to 1 hour trust generation, and in fact, potentially instantaneous, which is exciting for us. Answering a few questions that have been asked here. Sandeep asked, if you do a CLAT in December, what rate do you use for the interest? And the answer is you can look back up to 3 months. And so you'd use the November rate, which is 4.4, which is the lowest rate that's available. So that's a good question and valuable. Farhan, you answered this. The deduction with a CRUT is typically 10%. You can get more. It's nuanced, and so I'd suggest that if you're really interested in pursuing this, set up a call for as soon as possible, and we can discuss it. Mike or someone asks, can you start the payout upon an event in the future? The answer is yes. You can do what's called a flip CRUT, which triggers standard payouts starting when you sell an asset or when you reach a certain age. Question is, are all these strategies still valid? Farhan touched on this. All of the ones on this slide are still valid for this year, still available, and we can get them done. Some of the ones that we're going to be talking about on the next slide are, and some are not, and we'll be very clear about that. And there was a request for a further CRUT explainer. I really appreciate the question. We are crunched for time, so I'm going to strongly suggest that you check out learn.valur.com, where you can find our guide to CRUTs. And I promise in 1,000 words, you'll get it. But if you have further questions, we're here by email. You can always chat with us on the site, and we're happy to explain further. All right, we have 10 minutes. I'm going to be quick on this stuff. There's a lot here. We're not going to go deep on especially real estate and solar. We're going to focus maybe a little bit on oil and gas because it's available and high value and doable this year. Real estate, the idea here, as most of you know, and I know at least someone, whether it was Noah or otherwise, asked, sorry, just going back, Ankit asked a question about CRUTs. I want to answer it. Yes, a CRUT can work for an IPO, for sure. If you have options that have not yet been exercised, it gets a little bit complicated. This is a great case for scheduling a call with us. We can walk through your precise case, run the numbers, and answer all of those questions for sure. So real estate, the idea here is that you're buying an asset that entitles you to significant income, yes, but also depreciation. Depreciation is almost the entire tax value of real estate and STR, short-term rentals. The idea is that you can deduct much of the value of the property over the next few years and use it to write off not only the income from the real estate, but potentially your earned income, your W-2 as well. The way to do that at a very high level is twofold. When it comes to figuring out what income you can write off, you can always write off passive income. You can also write off active income if you become a real estate professional. I'm sure many of you have come across the requirements that you spend 750 hours in the business. Very often there'll be a working spouse and a real estate spouse. If you want to do that, you need to look into the details. It's definitely not something that you're going to do this year, but you can pursue for next year, and it can be powerful to write off ordinary income. Specifically, how to get the maximum depreciation. That's where someone asked this question. That's where cost segregation comes in. The idea here being that if you engage a cost segregation appraisal specialist to run a study, you can get the precise value of all of the different components of the property, the land, the personal property, the real property, the building. And each of those pieces is on a different depreciation schedule. And some of them are on accelerated schedules. And so you can write off the depreciation even quicker if you do that. Again, not something you're going to do this year, and so we're not going to linger on it. Sandeep, going back, asks, can we fund a CLAT with stocks, RSUs? Absolutely, 100%. You can fund a CLAT with almost anything, including cash and stock. Okay, solar, also going to speed through here because to answer a question that was asked, unfortunately, solar is at least going through Valur, and I think anyone else will tell you the same. It's too late to do solar this year, just because the requirement is that you invest in solar and that the project be completed by the end of the year. Now, there is a 90-day grace period in some narrow cases, but those are on lower value projects that Valur doesn't do. And as a result, solar is done for the year. That being said, it is a very powerful strategy for ordinary income, and it's probably the thing that most of our clients pursue over the course of the year. So it's worth double-clicking for 2 minutes on it. The idea with solar is that you are purchasing physical infrastructure. You're buying solar panels that are sitting on the roof of a commercial building or a community center. And yes, to answer the question, you can do this with Valur. Or sitting on a residential development out in California. You become the owner of that project, and in return, you get 3 financial benefits. The first, and this is where the credit and deduction distinction comes in. The first is a tax credit. If you put $100,000 into solar, there's a lot of math behind the scenes here that we can talk about maybe another time, or you can check out our calculators. But if you put $100,000 into solar, you're probably going to yield something like an $80,000 federal tax credit. The math again is complicated. I'm not going to spend the time here. We've done a solar webinar, which you can find on YouTube if you want to check it out. And we'll also be returning to this early in January to talk in more depth. But you get a tax credit, you get a depreciation deduction, which is, again, just like with real estate, you get to deduct the value of the property of the solar panels that the IRS assumes to be lost over time as these things lose value just because they're physical infrastructure. You get to deduct that value over 5 or 6 years. It's also front loaded. It's on what's called the bonus depreciation schedule. And you're able to take much of that depreciation in year 1. And then the third benefit is income. This is, you own a business, a project that produces electricity that is then sold, and you get income from that. This is all run by someone else. You don't need to go out and find a buyer for the electricity. It's actually very simple, and Valur helps you with it. But all in all, we're talking about in the first year, potentially as much as $1.30 in tax savings for every dollar that you purchase of solar panels. If you put $100,000 in and you live in California, you're going to be able to reduce your taxes by as much as $130,000. And that's not a typo. That's not I'm not misspeaking. You're getting back more and potentially much more than you're putting in. And as a result, as I said, solar is very, very popular. And if you're interested, because of inventory limitations and these timeline requirements, strongly suggest that you get in touch with us early in the new year, really in the first quarter, to get moving on that, at least to start exploring and kicking the tires. There are some requirements there. Material participation, you have to spend 100 hours in the solar business. You also have to do your diligence on the particular developer you're working with. Again, we've got 4 minutes left. I'm not going to belabor those points since this is out of the picture for this year. I want to leave those 4 minutes and maybe a little bit longer. And Ankit, the answer is yes, solar will survive under Trump, in our view, for a lot of reasons. It was passed in a bipartisan fashion, 50-something votes. Seems very unlikely that this particular very popular program is going anywhere, but we'll keep an eye on it. It also won't be removed retroactively. If you invest in January, there's rules that prevent the government from taking away those benefits once you've invested. So, and then the last topic here, which Farhan's going to talk about, is oil and gas, which is the last one of these and the most valuable one that is still available this year.
Yeah, thank you, Jeff. And just quickly, one statement. The reason that, so real estate requires you to put in certain amount of hours, is 750, and solar requires you to put minimum 100 hours within a calendar year, and that's why it's just not executable within the time that we have left. With oil and gas, there isn't a distinction. With oil and gas, the way this works is you put money in a fund, and fund invest that money into oil wells. They drill oil and gas. That's what they are essentially doing. The distinction here is that oil and gas doesn't require you to put any hours into it. It doesn't require you to set up any entity, and that's why it's a very simple structure. And we're talking on 18th of December, and we can say with very much confidence that we still have time to do it, at least till December 27th. So the good part is, with oil and gas, if you put $1 in, you are able to take 90, close above 90, 92, 93 cents, but just for the sake of selling it, slightly conservative approach. If you put $1 in, you can get 90 cents worth of a reduction against your federal AGI. A lot of states accept IDCs as well. You'd have to check. California doesn't. We know we have a lot of client base in California. California doesn't. But if you put $1 in, you are able to get 90 cents worth of a reduction against your AGI. You are able to get it 17 cents from year 2 through 7 with the depreciation schedules. If you combine them, you get to 107. But that's a depreciation. That's aside. You are also entitled to cash flow. As the fund is going to drill oil and gas, there's going to be cash flow that's going to get generated, and you would be able to take that cash flow. However, no one is going to commit to you a definitive percentage, because, as everyone knows, oil and gas prices are highly volatile based on oil and gas prices, what's going on into international politics and everything. But what we have seen historically, that people have been able to get their money out and more over the course of 4 to 5 years. First couple of years are very aggressive because they extract majority amount of oil and gas. And so to sum it up here, and when I was saying, Jeff, that I'm going to link it up to gas, is oil and gas is statutory. It doesn't require you to put any hours in. It doesn't require you to set up any entity. It's a very simple, plain vanilla structure. So IRS is not going to come back and ask you why you weren't active, why didn't you spend any hours. It's just safest thing you can do out of all three. In terms of, if you're connected with DAFs, it's the same profile. In DAFs, you're going to lose the $1. Here you get more than $1 worth of deduction. 90 cents in year 1, not bad. But you have an upside of making your money more on top of it. 15% of the income is tax deductible. We've seen people making 150, 200% cash on cash return. We're happy to dive into it and can explain in more details that how that works and everything, the nuances with it. But just to lay it out, this is available. You can execute it with the time that you have left. And we're happy to chat about it.
And just to kind of continue and close the loop here, someone asked about minimum investment is $100,000 minimum on oil and gas. You can absolutely do it this year. The oil and gas is maybe the closest thing that we do to an investment strategy. It's really a hybrid, right? Solar is mostly a tax play, and then there's some revenue that comes along with it. Donor advised funds, CLATs, CRUTs, these are tax strategies, and you invest within them. Oil and gas is really hybrid. It's 50-50. You're getting a very large tax deduction in the first year and a little bit in future years. And as a result, you're basically getting something like a third to half of your invested capital back in tax savings. But this isn't going to be valuable unless the fund returns cash flow. And so as you're evaluating this for yourself, what you need to look at is the historical returns, which we have on our site. You can, again, check out learn.valur.com, look at the oil and gas materials, and we publish the historical returns from these funds. And you need to decide if you believe that those are likely to continue or potentially improve. And I think there are reasons, technological and policy, to expect that these funds are going to return more than they have historically. But it's still something you have to underwrite, something that you have to decide on for yourself, and decide whether you believe that this is going to return money the way that it has historically. And if it does, then it's very, very strong and positive. And like Farhan said, we've got dozens of clients pursuing this, but it does require a little bit more kind of belief in the underlying investment.
That's right. And one thing to call out here, I mean, even if you're looking at, real estate and solar, there is, clearly a 750 hours requirement with real estate. That means that's a lot of time that you would have to put in. I mean, it's like, there's an underlying requirement of it has to be, 50% of your working hours. And with solar, the requirement is slightly lower, but it's 100 hours. So there's work that needed to be done in order to achieve solar. There are different risks and everything. The beauty of oil and gas is, one is the material participation, which means you're not doing anything. You're not running fund, and you're not going down and reading about oil and gas and how's it doing and what are the drilling pits and where the wells are located. And time is money, in a sense.
Let me put it this way. Oil and gas is the lowest overhead thing that Valur does. As you have seen today, and as many of you know from chatting with us over the months and years, and answering the question, again, minimum investment for oil and gas is $100,000. And answering one more, California, you can invest in oil and gas. California does not recognize the deduction, so you won't get a state deduction, but you still get the max federal. But the point I wanted to make is that Valur helps with many of the things we've talked about today. Essentially everything except the tax-deferred plans like IRAs and 401ks, and donor advised funds. If you want to do a foundation, if you want to do a CRUT, a CLAT, solar, oil and gas, Valur can help. And oil and gas is the thing that requires the least setup, the least overhead, the least involvement from you. And that's fortunate because we've only got a couple of days left in the year to get it done. But if you're interested, it is absolutely still viable. But I'd strongly suggest that you get in touch within the next 2 or 3 days, at least to kick the tires and get the process started. We are over time. I'm shocked. I thought this was going to be a 10-minute webinar. Surprised that we had this much to say. Ash asks, or someone asks, does Valur help with foundations too? The answer is yes. It's not something we advertise because it actually, just candidly, it isn't in super high demand. It's a higher end product. But yes, absolutely, we can help you set up a private foundation if you're interested. So with that and everything else in mind, and trying to wrap this up, strongly suggest that if any of this is plausible to you, and whether you want to ask questions or you want to pursue something like this, set up a time to chat. We are available. We'll be online and taking calls all the way through the end of the year, and of course into the new year. So don't hesitate to click on that link, schedule a call. You'll get one of us. You can also email us directly if you have questions. I'm Jeff at Valur. Farhan is Farhan at Valur. You can always email support@Valur if you just want to ask the team a question. So don't hesitate to get in touch. We keep getting substantive questions, and I don't want to give them short shrift. Can we get a reference on past users on oil and gas cash flow returns? Very candidly, this is something that Valur has gotten into this year, but the fund we work with has been doing this for a long time, and they can absolutely point you to references.
We're happy to share the historical returns as well from the fund side, that what they have been able to get in terms of the cash flow.
That's right. That's right. So email us, schedule a call, come onto our site. We have a little chat button in the bottom right. I'm sitting there like 20 hours a day answering questions, so don't hesitate to write there. I'm gonna just hijack Mike's comment here. We really appreciate you all coming. Many of you have been here. Sorry, I'm gonna pull that one down and do one more substantive question. No appointments in the next few days. If you don't see an appointment on the link, email us and we will find a time, even if it's late or early. Yes, we're busy right now. Unsurprisingly, many of you and others are trying to get in. We're taking calls 8, 9, 10 hours a day. If you don't see anything and it's helpful to hear from Ankit or whoever made that comment, we'll try to open up some more availability, but always don't hesitate to email us and we'll find the time to chat. But yeah, we've got more of these coming up in January. Many of you have come every week for the last 6 months. We really appreciate your time. We appreciate your good questions, you sitting down with us. We hope you all enjoy the holiday season and the new year. I don't want to, cut things short. If you have, something you'd like to do with us, get in touch and we'll get it done before the end of the year. But if not, we'll talk to you all on the other side in January. So we appreciate it.